All right, welcome everyone. Thanks for your time and welcome to our special edition webinar today with Ryan Simonetti, the co-founder of Convene. For those of you who are not familiar with WREA and might be joining your first webinar today, WREA is a 70-year-old real estate organization where we unite to do charitable and social endeavors. You can check us out on our website, ymwrea.org. So before I turn it over to Alex Caskell, one of our governors of WREA, just want to let you know that you could submit any Q&A through the bottom of your screen, and we'll get to Q&A at the end of the presentation. Alex.
Thanks, Laura. I'm pleased to introduce Ryan Simonetti. Ryan Simonetti is the CEO and co-founder of Convene, a company that designs and creates premium places to work, meet, and host inspiring events. Ryan co-founded Convene in 2009 with the intention of disrupting the commercial real estate industry and transforming the workplace experience by capitalizing on converging trends in real estate, technology, and hospitality. Since then, Convene has expanded to 32 locations across the US and UK and has raised $410 million in funding to date. Convene has been named one of America's 100 most promising companies by Forbes and a best workplace by both Inc. and Fortune magazine. Ryan has been recognized on Real Estate Forum's 50 Under 40 list, Inc. magazine's 30 Under 30 list, was named top entrepreneur by Crain's New York, and a finalist in Ernst & Young's Entrepreneur of the Year New York Awards. Ryan is an active supporter of the Urban Land Institute, Coronet Global, IACC, and was selected to be a member of New York Senator Kristen Gillibrand's Small Business Working Group. Ryan and his wife Lisa live in New York with their children Riley and Harley. Ryan is a good friend and a great person. I'm pleased to present to you all Ryan Simonetti. Now, to hop into our discussion, as most of us are based in New York, and Ryan has always been a big forward-thinking person. Ryan, what are your thoughts on the future of cities and how they will recover in the context of the pandemic we're going through?
Yeah, well, good evening, everyone. And I'll apologize in advance if you hear my noisy children in the background. It's about this time that they start to go stir crazy. So you might see them even pop into the screen and say hello. So Laura and Alex, thank you so much for giving the opportunity to spend time with you and the group tonight. It's a great question, and it's obviously one that we've been thinking a lot about, not just since the crisis started, but one that I've been very passionate about, especially around future cities and how does work, live, play, and that ecosystem have to come together. And I think it's a really interesting time to think about that, especially within the context of New York City. When I think about the situation today, you almost have to bifurcate what's happening in New York and how New York is being impacted, and then put the rest of the country almost in its own bucket. And I think that the challenge in New York, given the dependency on public transportation, the verticality and the density of the city, and how tough it is to manage all of the risks associated with this virus in that environment relative to, I think, a lot of the other cities and states that we operate, and even as we think about Convene coming back online, we're assuming New York is probably the last market that ultimately comes fully back because of that. So I would say there's what's going to happen to urbanization and what are some of the long-term trends, macro, and then I think it's also about what's going to happen in New York. And I think it probably makes most sense, just given this audience, that I talk a little bit about New York and what I see happening, not just in the short term as we work our way through this crisis, but what are some of the longer-term impacts to not just New York, but also to the region. I think one of the things I know from being on the board of the Regional Planning Association is New York is the hub to New Jersey, to what happens in Connecticut, to obviously what goes on in Long Island, and really is an anchor for this entire region. And this whole ecosystem works together really with New York at the epicenter of it. So a couple things. There were some really big trends that have been happening for a very long time, and I always reference PwC published this amazing kind of macro trends, like what are the big global trends that are going to impact the way that we live and work and how our societies operate for the next 50 years. And one of those trends is urbanization. And New York has gotten obviously an incredible benefit of that trend over the last decade, since we've been recovering from the last crisis that we faced back in 2008 and 2009. The question is, in a post-COVID world, as companies think about where their offices need to be located, as people like myself with families think about where they're going to live, there's big questions to ask yourself now. And I believe that some of the challenges that New York has had that have been kind of running under the surface, things that we at the RPA have been talking a lot about, the modernization of our infrastructure, the quality of our technology infrastructure, our healthcare system, which I think has been tested and continues to be tested today, and affordability. And those were 4 big issues that have been kind of under the surface. And because the economy was so great, you could kind of put those things to the side, and New York was able to still run and function, right? Despite really losing population growth over the last few years because of some of these issues. And to me, this crisis has really exposed those things fundamentally in a different way. And, I'm super bullish on New York long term, but I think New York is really going to be challenged the next couple of years, because I think some of these other trends that have been out there, right? The shift towards virtual and remote work. We were just talking, Laura, Alex, and I, before we jumped on today. One of the beauties of this whole experience has been, I think, a breaking down of the barrier between work and life, and this idea that we have a persona and a personality that goes to the office and a different one at home. And what's been so amazing about this experience is that not only can we work from virtually and remotely, but to a certain extent, we're able to be our more authentic and genuine selves. And I've done town halls with our company, which I would have never thought would have been possible, which we usually do physically, where my son or daughter will end up jumping on my lap in the middle of the town hall. And I think we've all come to accept that, right? Or if a dog jumps in, or if somebody's not wearing a suit and tie, or like clearly a guy that needs a haircut. And I think that, this adoption of virtual work and remote work, and what I think is the end of really the taboo around that, really starts to call in question a lot of things, right? Not just how much office space do companies need and where do they locate, but also where do people end up living. And I do think that you will see a shift, not too dissimilar from what New York saw after September 11th, where you will see an exodus of people and businesses out of New York to suburban markets in and around New York City, and then potentially to other cities. People don't realize, and New York isn't just competing with San Francisco and London and Hong Kong anymore. New York is competing with Nashville and Austin and Tampa and a lot of these Denver and some of these second-tier cities, not just for corporate occupiers and businesses, but also for talent. And so I do think that we will see an acceleration of adoption of virtual and remote work, which we'll talk more about today, which obviously is something that we as a company are spending a lot of time and energy now trying to figure out what that means for our business. And I do think that New York is going to really have to address some of these foundational issues that have been kind of pushed to the side, and really reimagine itself, not just as a safe and healthy destination, but really an ecosystem that better supports work and life and all the things that kind of have to happen as a part of that. And we have to fix the public transportation infrastructure. We're going to have to rethink about healthcare and the access to that. And affordability is a major issue, not just for residents, but also for retailers. And one of the things that we're seeing through this crisis is that, in order to entice retailers back, we're going to need a much different cost basis from a real estate perspective to have that happen. And, I think New York is going to have some real challenges. But with that said, if there's any city in the world that knows how to bounce back, it's New York. And I remain bullish. And I know we've got the leadership and the commitment to figure it out. But it's urbanization, especially in New York, is going to be tested a little bit. And I do think that some of the suburban areas in and around New York will end up getting the benefit of some of the exodus that ultimately does happen over the months ahead.
So perhaps a little bit more granular, what's your view on, the pandemic's effect on co-working, flexible office space, and, traditional office space in the short term, intermediate term, and long term?
It's a great question. And again, for those that maybe don't have as much background or color on Convene, and even myself for that matter, I'll do that and then I'll jump back into the question. When I started my career, I actually interned at Goldman Sachs on their sales and trading desk. I went to school at Villanova, just outside of Philadelphia. As much as I love the energy of trading, I grew up in a family where my dad was a sole proprietor. He was a small business guy, an entrepreneur, and I was always so fascinated with business. And I spent a lot of my summers as a kid, working with him in our business. Actually, interestingly enough, it was a hospitality business. He serviced the restaurant industry and also supermarkets and stuff. I don't know if anyone's ever had a Shake Shack burger, but that bun is a Martin potato roll. And my dad owned one of the first delivery companies for that company in Somerset County, New Jersey, where I grew up. So I always say that entrepreneurship is part nature and part nurture, and I probably got a little bit of both from my father. So since I always wanted to own my own business, being a trader felt too far away from the company, and I really wanted to get into investment banking. And this was at a time where, right or wrong, you couldn't get an investment banking job out of Villanova, right? We weren't an Ivy League school. We weren't one of the top 3 or 4 that they recruited from. So I wasn't able to kind of jump the fence at Goldman, and I ended up having to go back out and try and find a place to work. And I was fortunate enough to get a job at Lehman Brothers in their real estate group back in 2005. And that's when I really just fell in love with real estate as a business and as an asset class. I got promoted after my first year there, was offered a job in their principal investing business, which at the time was a big part of that platform. But I really wanted to get into a more entrepreneurial startup environment. And I had been looking and was fortunate enough to get a job at a company called Gramercy Capital. At the time we were GKK, now it's Gramercy Investment Trust, which is a net lease business, completely different. And I'd say I really learned the industry there. I think when I joined, I was the 6th or 7th employee there. We had 300 million in assets under management. Within a very short period of time, I think we had 8 billion in assets under management, and we invested across the capital stack, asset class agnostic. And randomly, I spent most of my time working on hotel deals and office building deals. And for those that know the company, SL Green was also our largest shareholder and main investor in that business at the time. And so I had to look into, obviously, the SL Green office business. And what was interesting is if you kind of can remember back to 2004, 5, 6, 7, this was really lifestyle as a movement, right? You've got the W Hotel brand, which was taking off. You've got all the amazing stuff that Ian Schrager was doing with the boutique hotel industry. Really, boutique in that industry was really starting to take hold then. You had the first, what I would consider lifestyle residential developments, where condo developers and multifamily developers were actually truly infusing amenities and hospitality and services into those asset classes. And then obviously you have companies like Equinox that were bringing lifestyle to fitness and wellness in a way that had never been done before. And what was always fascinating to me is if you sat in the room with a hotelier, the way that they think about creating value is through experience. It's design, it's hospitality, it's service, it's dynamic pricing, it's how well they can sell and market. It was all about the customer experience and the customer journey, which is fundamentally a different 2006 and 2007. There wasn't an office building an office building owner in the world at that time that was talking about flex space, around amenitization, around tenant experience. Guys, like, office landlords didn't even start calling their customers until like 3 years ago, when they stopped being tenants and actually became customers. And the opportunity that I saw when I was at Gramercy is, well, what if you took the best of hospitality and you actually infused it into an office building environment? Could you fundamentally improve the experience for the tenants in the building and the customers? And would they therefore pay you more to be in that building? Just like a Class A multifamily asset that delivers amenities gets a premium to a Class B that does not, or a premium boutique hotel gets a higher RevPAR than a limited service hotel that does not do those things. Could you actually fundamentally change the value proposition in an office building by integrating hospitality and amenities? And so our thesis was, well, what if you ran an office building like a hotel? And what we've done over the last 10 years is build a brand and a platform and a capability to help landlords understand what are the types of spaces and services that today's tenants demand and require, and how can they partner with Convene, just the same way a hotel owner would partner with the Four Seasons or W or Marriott or Hilton, and really use our brand and our capability to help them rethink the experience in a building and ultimately increase the value of that asset through better velocity of ramp up, higher overall occupancy, better tenant retention, and then ultimately overall asking rents. And what we've seen over the last 10 years across our 33 locations is not only Convene make money on the space that we operate, but what we've really been able to do is fundamentally change the Argus metrics and the valuation and the income production of a lot of the assets that we've gone into. I'll give everyone just a quick case study. We partnered recently on a building in Chicago. It opened about, I think maybe 8 or 9 months ago. That asset had been vacant in the West Loop, had always struggled to be occupied. And we partnered with the developer there, Sterling Bay, who's been a great partner of ours. And we said, hey, we have a strategy to reimagine this asset. And the way that every investor was thinking is that you had to do it from the outside in. You had to reskin the building, and then you had to come in. And we said, actually, you don't have to do that. Let's redevelop it from the inside out. And we partnered with Sterling Bay. We took the entire base of the building, about 25% of the asset. We built in a high-end meeting and conferencing space. We built a coffee shop in the lobby and a bar that feels like you're walking into a boutique hotel, not to an office building. We built our flexible workspace product, which is really just a different way for a landlord to deliver spec suites in a highly serviced way. And in less than 6 months, that building went from 100% vacant to 100% occupied. And 2 of our biggest customers in Chicago, who were out looking for space, decided to co-locate in that building with us, even though it wasn't a new Class A, brand new construction building, because of the experience that we were delivering in the building and the fact that they didn't have to build their own hospitality space. They didn't have to build a kitchen. They didn't have to build their own suite of amenities and services. They didn't have to take a floor of expansion space that they may never use. They could just tap into the infrastructure that we and the developer ended up building into the building. And that's really what Convene is all about, right? It's about delivering a great experience to an end user and at the same time working with a landlord ultimately to create value. The question is, in this world today, what part of that makes sense and doesn't make sense today? And I think what we're seeing is you almost have to your point, Alex, there's the short term, the medium term, and the long term. Right now, all of us, most of us are focused on the short term, which is really around how can we safely reopen locations, right? And this isn't just about Convene spaces. These are buildings. These are tenant occupied spaces so that we can create, to the best of our ability, knowing we can't do it perfectly, an environment that is safe, that is healthy, not just for Convene's staff and team, but also for our customers. And we're working closely with us, with our customers, with landlords, right? Because the communication required between tenant, us as service provider, and landlord today is, it has to be so much more seamless and connected than it's ever been, because we're technically working together to make sure that that building is safe. And that's a really, really big challenge. And it's really, really complicated in New York. Like, I will tell you, one of the things that we've always been focused on as a hospitality company is something called hello, coffee, goodbye. How do you feel when you show up? What's the last thing you remember you had with us? And how do you feel when you walk out the door? And we've always worked really hard, whether we controlled the experience or worked with the landlord, to make sure it felt good when you showed up and felt good when you left. And right now, if you think about the complexity of getting into an office building, especially a tall tower today, it's going to be really hard to make that experience feel good. By the time you factor in social distancing, a limited number of people that can go into an elevator, right, which maybe is going to be 4, maybe it's going to be 2. I think different buildings will pick different paths. To think that people will have to queue and potentially wrap around an office building and wait in line to even get their temperature checked at the door, ultimately to make it into an elevator, it could take 25, 30 minutes to get from the line into your office, right? It's such a complex problem that we and our landlord partners are obviously trying to solve. So the short term right now is about safety. It's about health and wellness. It's around how do you redesign our spaces to maintain social distancing. We don't really have to worry about density. There's all this talk about density. The reality is it's all opt-in, right? There's not a company in the world out there today, at least a progressive one, where the CEO or head of people and culture or CEO is going to say, you have to go into the office. Like, that's not going to happen. Right? That's not going to happen probably ever again, especially since we now know we can work virtually the way that we can. And it's really going to be up to the individual user to choose if they go into the office and when they go into the office. So the whole thing around density is, the reality is, I don't see a situation in New York until there's a vaccine where I don't see any building being more than 15, 20, 25% occupied at any given time. And I see none of our spaces being occupied more than 25, 30, 35%, period. Because I do not see a situation where a company can make it mandatory that somebody shows up at work. And if they don't, that there's going to be some penalty to them, like they're going to lose their job. It's just not, I just don't see that happening. So I'd say short term, it's all about health and wellness and safety and cleaning. And that's the blocking and tackling that we're all going to do, right? We as an operator are going to do, landlords are going to continue for the next 12, 15, 18 months, as long as this goes on. Where I'm spending more of my time and energy, and I actually took our company, we had to make the really challenging decision as part of this to cut costs. With all of our locations shut down, at least now, we furloughed a bunch of our team. So we took our team from, that was about 860 before this started, and we're now down to just under 200 that are non-furloughed. I've got half of them working on how do we block and tackle and reopen safely. And then I've got the other half of the company focused on the future of the business. And that's where we have to start to think about what's the medium term and long term. And then how does a company like Convene, with the capability and the competencies that we have and the expertise, like where can we actually identify problems and create solutions for our customers, both our landlord customers and our occupier customers, that are actually going to be relevant, not just over the next 12 months, but 3 years from now, 5 years from now, 10 years from now. And the way we're thinking about that right now is, I believe the future of work is called hybrid. HQ, whether you run it or Convene runs, it doesn't matter, but I have an HQ, a corporate headquarters location, a hub. Then I've got a third space, which is really my spokes. And whether that's a small satellite office that I have, or it's outsourced to a co-working company, or it's outsourced to Convene, or I go to a Convene space, that's the third space. And then I've got this new thing called virtual and remote, which people have been talking about adopting. But the reality is, if you look at the real numbers and stats, a very, very small percentage of what I would think about the white collar workforce actually works remotely and virtually. And what I can tell you, based on all the survey work we're doing with our members and our 6,000 clients, with all the conversations I'm having with the heads of real estate and CEOs that are going to make these decisions, I'm hearing anywhere from as low as 10 to 15% to as high as a third are going to have the ability to work virtually or remotely. Now, does that automatically mean a company needs a third less office space? I don't think that's the answer, right? Because some of those people might work virtually or remotely 60% of the time or 80% of the time, but still have to go to their HQ or still go to a third space. And so the question now becomes is, okay, well, if a third, let's say, or 25% goes into the virtual remote bucket, the rest of the demand, whatever that is, how does that get split between an HQ and a third space? And third space is all the stuff I would outsource: amenity space, meeting and conferencing space, like all of this infrastructure, which most landlords today are underwriting up to 5, if not 10% of their building right now is third space, as I would define it. And that's where we're trying to get a sense right now. My gut is telling me, best case scenario, the demand for space is the same as it is today, or low. Like, and then I think off of that is like, it could be 15, 20, 25% less over time. Right. I think that's a real thing. We're hearing a couple of our customers are saying, I'm going to need to take more space because I'm going to have to be less dense. That is by far the minority. It's definitely not a progressive company. I mean, any progressive organization that we're talking to, whether a progressive law firm or progressive financial services, is not saying, I'm going to go take a bunch more space. That's definitely not what we're hearing. And so I think where we play in that world is, can we build a platform that's able to deliver a great day at work wherever it happens? Can we support you in your HQ, either as an amenity provider in the building or actually designing and running your HQ for you? We know we can be a third space, and can we do that in partnership with the building owner and create and run these, whether they're white label to the landlord or branded Convene, or it doesn't really matter. Can we run that? And then can we build a digital platform and a virtual services platform, whether that's through chat or else, where we can put a human behind creating a consistent experience for a remote and virtual workforce? Because working from home has its own unique challenges, right? And what we're hearing in our surveys is that working from home is great, but not for everyone, right? If you're a young person, have 3 roommates, and you're using a shared living space, like, working from home sucks. Like, let's call a spade a spade. I'd rather be in my office, or maybe from a co-working space or a coffee shop space. I got to get out of my apartment. For people working from home that have children at home and don't have their kids in school or don't have childcare, working from home is hard. Like, I know that I've got my wife and I have been dealing with that as 2 working parents, where, our kids are trying to do school virtually. We're sprinting between Zoom meetings, trying to figure out who's going to do their schoolwork. Like, it's hard and it's stressful. And then you have a group of people who's saying, like, you know what, my kids are out of the house. I don't have to commute 2 hours to get to the office. Like, I'm perfectly productive at home. And by the way, that airplane trip I used to take one dinner with somebody in London or in San Francisco, like, I don't need to do that anymore. Like, I'll grab a glass of wine and I'll do Zoom and I can take that meeting. And so we as a company are trying to figure out, how do we play into that ecosystem? Knowing that we as a company want to support you, like, wherever it happens, like, we as a platform want to be there to support you. And that's really, I think, the 2.0 strategy for Convene that we're starting to execute against.
That's great. Super insightful. So
I know there were some tough questions in there, so you could grab the zingers for me, Alex.
Yeah, I'm looking into this. We got a bunch of questions on here. So given the reduction in density, meaning people per square foot, are you looking at price changes? And if so, what underlying assumptions are driving the new pricing model?
Look, it's an amazing question. It's one that our revenue management team and our sales team has been spending a lot of time thinking through. What's interesting is the way that Convene has historically priced is it's the greater of X dollars for the space and the experience, and a per person rate. And I think what's going to happen over the next 12 to 15 months is that the per person rate doesn't actually matter anymore. It's really just like, what does it cost for the experience in the space, right? What does it cost to design that? What does it cost to operate that? Like, and then what's the right pricing model to build on top of that so that we can still make money as a company, right? Like, and my sense is that we're actually not going to see a ton of pricing change in the baseline, like, what is the space and the experience cost? Because people are going to be rotating through space in a different way. Like, most of our clients are talking about week on, week off, or day on, day off, right? And so they still need the same space. They're just going to have half as many people rotating through. And if you want to maintain social distancing, which you have to do, you technically need the same amount of space to accommodate half of the people. And we don't think that for that reason, that magically the value that we're delivering as a company should be any different than it was beforehand. So if we see pricing changes, it's really going to come about because of economic impact, right? And right now we're assuming and modeling out a pretty severe 3-year recession, kind of starting, let's call it June of 20. And then we don't see ourselves coming back out of that until, second half of 2023. And it definitely doesn't look like a V. It looks a lot more like a U. We will see pricing pressure because of that, right? If less people need space, you're going to see pricing compression. I mean, it is what it is. Now, with that said, people are less price sensitive when it comes to health and safety. And if I can go into an environment and know that my people are going to be safe and healthy and that company is doing everything it needs to do that, I'm probably less price sensitive. And we're hoping as a premium brand that's doing all of those things that maybe our competitors see a lot more pricing pressure than we do, and that we get the benefit of being a premium brand that does the right thing, making all the right investments. And the only way that works is if people are willing to pay for it, right? You can't support a Four Seasons at, a Holiday Inn price point. Like, that just doesn't work. Our customers so far haven't put a ton of pressure on us and have been willing to pay for premium and security and safety. I mean, we had, not in our meeting and conferencing business, because that's obviously been destroyed right now, but we had one of the best booking periods in the history of our workplace product over the last 6 weeks. So to me, that shows that people are still willing to pay, and they're willing to pay for quality, and they're also willing to pay for flexibility, right? I can't see imagine being a 200,000 foot occupier today looking for space. Like, what do you do? Like, how could you make that decision today? You can't. And I think the fact that a lot of stuff's not going to happen for the next 12 months as we work through this, I think there's going to be a lot of demand for flex space, shorter term space. And I think we as a company are pretty uniquely positioned with our landlord partners to deliver that solution to that.
Great answer. And on that point about conferences, I just got a question from Justin Royce. It is, what is Ryan's view on the conference side of the business, and when will that start to return in some form?
Yeah, look, a great question. I'd say the easiest answer is short term, pretty shitty, honestly. We don't know what government regulations are going to be put on us around gathering size. And I think every city and state will probably end up at a different place. And I think everyone will look to the CDC for guidelines and recommendation. What we're assuming right now is that all meetings over 50 people, are canceled between now and the end of the year once shelter-in-place orders are lifted. And look, for us, we have certain venues, like the new location we opened at Brookfield Place in the old Sac space, which is a stunning venue. We were doing 500, 600, 700 person meetings in there. It's going to be a long time before people feel comfortable doing a 500 or 600 or 700 person meeting. So we think in the short term, obviously the business will be impacted. The two areas that we are seeing demand and where we've kind of pivoted the meetings business to is what we call hybrid and virtual. We've been doing hybrid live stream conferences since 2010. We actually hosted the first ever hybrid conference in North America, where it was at a Convene and we live streamed to multi-points globally and then also to a large virtual audience. And we do see a lot of growth in hybrid. And what we're hearing from our customers is the 100-person meeting is now going to be a 20-person meeting in person. And then we're going to broadcast out not just to 80 people, but maybe another 200. And so what we're doing right now is going back into our meeting facilities and saying, one, how do we provide the safest possible place to have a meeting today? Safer than any customer could ever do in their own office. We're calling it like meeting in a bubble, and we're publishing that stuff publicly for our clients, if not later today, then I think tomorrow. And the second part of that is, how do we have the technology infrastructure in the room so that we can produce a production quality virtual experience for our customers that are participating? And I can tell you, having now done a lot of Zooms, a lot of Teams, and a lot of WebExes, both as a participant, as a speaker, right, as a panelist, not ideal, right? Like, we, the three of us that are on this right now, should really be sitting in a physical space doing this, broadcasting out to the people participating virtually if we really wanted this to be what we wanted it, wanted. And we see that it's actually a really big growth vertical. And we're getting inundated with requests right now for hybrid meetings, and are doubling down on that strategy. And we'll need that strategy to get through the next 12 to 15 months before I think we're in a position where large meetings and events come back. Medium to long term, I'm super bullish on our meeting and conferencing business, because the two biggest costs to a meeting and event also happen to be the two biggest risks today, which is travel and staying in a random hotel. And where we see a huge opportunity is we think that being local, that there's going to be not just a flight to quality, but a flight to local. And the fact that, I don't have to get on an airplane or don't have to go stay in a hotel, not just to spend the money, but also to take on the risk of that process. We do think when meetings come back, that Convene is going to be in a beautiful spot and really get the benefit of a lot of this pent up demand by being really a local, truly at our core local provider. Most people don't realize this, but 80% of our participants, which means 80% of our meeting revenue, walks to us within 5 blocks or drives to us in a market like DC within 20 minutes. We are a hyper local provider of meeting and conferencing space. And I think that stuff comes back first. And then the destination stuff, like the thought of getting on an airplane, flying to another country and being with 500 people, that to me feels like 2 years to 3 years away. And I think Convene will actually get the benefit of not having to do that to have a great meeting at Convene.
Great. And I know that Convene places a large emphasis on design. I know that you guys have your own in-house architects. Do you see the architects and you guys in the C-suites making big changes to the way that you're going to lay out spaces going forward?
It's funny. We've been having this debate internally. What people don't realize, the issue isn't the design of the space. It's the HVAC infrastructure. And I think way too many people are talking about the space and not enough people are talking about the quality of the air that we breathe in the spaces we occupy and in the buildings that we go into. Very few buildings, if any, in New York City are running the quality of, let's call it, air purification infrastructure that I think would be defined as like living up to the Delos well standard today, right? I'd say that that's the minority. So where we're focusing our energy and attention is like, of course, in the short term, we're going to have to move furniture and create less density. We're really focused right now on HVAC infrastructure. And where we're rethinking things is, if I'm in a private office, but I'm breathing in the same circulated air that came from somewhere else, then who cares whether I'm in a private office or not? I'm just as susceptible to getting the virus as I was if I was outside sitting at a bench. And so that's where we're really putting our time and energy, is working with our engineering firms and some of our architecture and design partners on rethinking the mechanical infrastructure and what are the investments we need to make in the HVAC infrastructure. What can we do from a lighting and a UV perspective to eliminate some of the airborne particles? And then how do we integrate more biophilia and plant-based stuff into our environments, again, to really purify the air? I think you're going to see more impact there than you will ultimately on the design of space. And if I was spending my money today, I wouldn't spend it in reconfiguring my entire office. I'd spend it in upgrading my HVAC infrastructure.
So you see, this wellness score that we've been hearing about become more prominent in the sense similar to how the LEED certified idea took hold?
Yeah, completely. And I know there's Delos and the well-being standard. My sense is that a well standard will become more important than a LEED standard, right? At the end of the day, to build a well-oriented space or building, you also have to be thinking sustainably. So they start to get really connected. But if I was to bet on a designation today and say, man, I wish I had one of the two, I'd much rather have a well-being standard than a LEED standard today, I would say, if I was out there selling to customers.
And which companies, from an investor standpoint, I got this question, which companies do you think are well positioned to profit from the building HVAC refit work that you've mentioned?
Look, I think a lot of the bigger engineering firms, obviously, I think stand to benefit as a service provider. I'm sure, some of the big mechanical manufacturers and infrastructure companies will get the benefit of it. The tough thing when you're us or a landlord, I mean, all that is more money, right? So if you have to put more money into your space and it costs you more to run your space and you can't drive more revenue, that usually doesn't bode well for profitability. And I think one of the challenges that we're having, and talking to landlords, I think landlords are having too, is like the cost and complexity of running space just increased exponentially. Like it is way more expensive to run space today than it was 90 days ago, and it will continue to be that way. So again, it'll be interesting to see what's the return back to companies like us and to building owners over time as we make these investments. Right now, it's way too early to tell. I can say that, some of the newer developments that we're going into that have made that investment from a velocity and pricing perspective right now are performing better than their peer set. Like we're in 22 Bishopsgate in London, and they kind of went all in on the well standard, and that business has continued to perform well. I mean, they just, they've had some really strong leasing activity, I think even post crisis. So I'd say it's probably too early to tell what it's going to mean to returns for asset owners and companies like us that have to make the investments. Probably really good for all the middlemen that are out there, in that part of the industry.
So tell us a little bit about that, your conversations with your current landlords, and tell us a little bit about the potential change in your leasing models with them, and how these conversations have gone, if any.
Yeah, I mean, we, part of our short-term strategy, when you're in a crisis like this, it's all about cash management. And, the first thing you do is reduce costs. For us, depending on the situation, our second or third largest cost is obviously in our leased portfolio, which makes up just under 2/3 of our portfolio is leased. The rest is all managed. So the managed business, you don't really have to worry about because that's a fee business where we're getting paid every month. We don't have to pay anyone every month. In the lease portfolio, thankfully, because we've been such a strategic partner to the building owners, and we were so early and transparent about the impact that this was having on our business, we've been very lucky and have restructured and renegotiated most of our existing leases to get some sort of temporary rent relief during this time period, especially while shelter in place is happening. And then what we're doing is we're amortizing that free rent over a time period at an interest rate. So, I think one thing you have to be really mindful of, whether it's as a partner or as a tenant, is you're trying to take advantage of this opportunity and be opportunistic to automatically cut a better economic deal. That's not really in the spirit of being a great partner today, right? We didn't plan for this to happen, and none of our landlord partners did too. And it's not fair for us to go to them and say, hey, you need to shoulder all the burden of this. And so everything that we've done makes them not just whole, but also guarantees them a return on whatever deals that we've negotiated with them. So thankfully, we got that done. I think we might have one or two more that are, we haven't signed paperwork on, but for the most part, the hard part there is done. And really now it's about shifting our attention to building out and accelerating the development of our managed services business, where we've got a handful of deals we're finalizing now for kind of managed locations that will open next year.
Yeah, so Mitch Arkin posed this question while you were answering that one, kind of piggybacking. So how does Convene grow from there, and what type of structures with landlords are you looking to do going forward?
Yeah, I mean, we've always believed in, even if you look at our leases, they're really not leases. They're really joint ventures and partnerships where, because of REIT regulations or a value add fund that needed to get financing or was trying to solve for a capital markets outcome, we would always kind of create a lease structure that really mimicked a partnership agreement, almost like a waterfall would be in a GPLP deal. So we've always kind of focused on partnership. I've always believed that the right alignment is not to do it through a lease, is to do it through some sort of managed deal or some sort of managed partnership, and really just a cash flow split in a waterfall. And so right now we've got about just over a third of our portfolio is that way. 100% of our pipeline is all managed. So I think we're kicking around a couple million square feet of opportunities right now. Some of that includes us running the entire front of house experience for the office building, where we're almost bolting on top of existing property management to run all the front of house customer facing stuff. And our technology will even run the front of house of the building as well. So the core of our business now is really a managed business, and that's where most of the growth is going to come from, and it's reflected in the pipeline that we have today.
Interesting. And you talk about Convene often as a technology platform in addition to workspace. What exactly does this mean? How does it help your clients and your clients maximize the use of your spaces? And then also with the relation to how people are working more remotely, how will the technology tie into that going forward?
Yeah, look, as a company, this crisis has accelerated a digital transformation that was already happening. If you look at the most successful brands that are out there today, whether it's a hotel brand or an Equinox or a Peloton or even the retailers today, all of the most successful brands are marrying digital and physical together in a way that feels seamless to the user, right? And I think about that as kind of an omni-channel experience where if I go to convene.com, do I get the same great experience buying a meeting or booking workplace or logging on to my admin portal and going to a community event as I do physically being at a Convene? That's really the challenge. And so when we think about digital transformation, what it means to Convene, it's really the digital UI and UX that kind of layers on top of our entire business that makes life better for our employees and then better connects Convene the business to our end users and customers. So what we've been building the last couple of years is, I would call it like Convene OS, right? It's the operating system. It's just like what iOS means to Apple, or the operating system that Marriott built means to Marriott, or what Equinox has done to run Equinox. It's really the foundational digital infrastructure that automates all of the what used to be human to human things, but now does that through software and technology. And then what sits on top of that is a website, a mobile app, an admin portal, right? It's all of the user experience, the digital stuff that the user touches and engages with. And it's our job to make sure that that digital experience is as good, if not better, than the physical experience that we deliver. And it's about reducing as much friction as we possibly can to make it a more seamless experience for our customers, whether they're booking a space, they're in a space, they're buying food, they're booking a meeting room, like it doesn't really matter. And the same thing for our team that has to deliver. And then ultimately where we want to get is to be able to use the data that comes from that digital platform to ultimately personalize the experience for an individual user. Right now, we can personalize the experience for a company. We're not yet able to personalize it for an actual individual user space. And at some point, we want to get our technology to a place where we can actually anticipate and customize the experience of Convene, whether it's physically or digitally, it doesn't really matter, but actually tailor it specifically to the needs of an individual user. And the reason, when you think about like, why does a hotel owner pick Marriott or Starwood, it's as much about the distribution and the product and the brand as it is about the digital platform. Our chairman is Fritz Van Passion, who was the CEO of Starwood Hotel Group for a very long time. And he led them through digital transformation, which created Starwood Preferred Guests. SPG is really just a digital platform. It's a digital loyalty. It's a booking platform. Before he left and they sold to Marriott, SPG was responsible for 55% of the entire revenue through the entire Starwood system. And when I think about the future of technology for Convene, this digital layers, like we want to build that for Convene, for our landlord partners, and ultimately for our customers. And the reason I pick Starwood's flag or Marriott's is because of that tech infrastructure and platform. And honestly, if I'm a landlord or an occupier for that matter, I don't want to have to spend the $20 million that Convene has spent in the last 24 months building that platform. That's not my core business. So part of the value we're bringing to both our customers and our landlord partners is that they can use our technology platform. They don't have to recreate that or rebuild that. So big focus for us, extremely important part of the value proposition, and is the foundation through which we can ultimately deliver Convene to our customers wherever they are in this new hybrid world.
So these customers, what type of customers are you seeing demand from, and what types of customers do you typically attract?
If you look at our business today, we've got about 6,500 customers. In our meetings business, we served about 600,000 people last year. We've got almost 3,000 members of Convene that we serve pretty much on a daily basis within our workplace locations. So we have a very broad set, right, of different industries. We've got everything from startup companies to mid-size to enterprise. About a third of our revenue comes from what we consider enterprise, which is a global multinational with over $1 billion in revenue, defines enterprise for us. The other 2/3 comes from small to medium-sized businesses. And so we're seeing demand from enterprise outsourcing all the way through small to medium-sized business. The need is the same. I need a premium experience. I need it to be safe. I want it to be seamless. I don't want to commit the capital to do it myself. I don't want to have to operate it because it's really complicated. I just want to outsource, period. Whether it's a landlord saying, hey, I don't want to build my own and run my own amenities and my own flex space and my own meeting spaces, or an occupier saying, like, I literally just don't want to run my office or part of my office. That's really who we're serving. And we see an equally big opportunity in small to mid-market as we do in enterprise. And we're kind of pursuing both of those channels equally, especially with some of our new products and services that we're launching.
So 2/3 of the companies are small to medium-sized businesses.
2/3 of our revenue.
2/3 of revenue.
Yeah.
Obviously, these companies right now are going through a very, very difficult time. Are you guys freezing rent, giving any rent abatement, promotions, discounts?
We proactively gave rent relief to every single customer since shelter in place was ordered in every market. Look, if you're part of going to Convene is the service and the experience. And if we can't open our location and you're just getting access because you have a badge and it lets you into the building, that's really not the Convene experience. And whether you were a Fortune 500 company that could clearly pay us, or you were a small business, I mean, we treat everyone equally. That's just part of what we believe. So, yeah, no, we've been giving full rent relief to all of our workplace customers. A lot of them, we're doing the same deal that we're doing with landlords, which is either extending their term and allowing them to, pay us over time. But for the period where they can't occupy the space out of no fault of their own or ours, we are giving them full rent credit. And then on the meeting side, it's a combination of giving people full credit for any meetings that they booked and making sure that they can rebook those events with full credit. So again, I keep telling people the decisions you make as a company today will impact the value of your brand for a decade. And if you think about it that way, there's only one decision to make as a company, and it's called the right one. And we've used that as a guidepost. Like every time we've been faced with a tough decision, we just say, like, what's right? Right? Like, if the Wall Street Journal was going to publish an article about us tomorrow, would they say we did it right or not? And it's hard to do that. Like, the easiest thing to do is not to do that. The easiest thing to do is to try and jam up your customers and collect as much rent, because obviously we're being financially impacted. And I think the fact that we didn't do that, my hope is that we'll build a tremendous amount of trust and credibility, not just with our existing customers, but for all of our customers that are in WeWork locations or in spec suites and their landlords aren't treating them the right way. Well, if you want to be with a company that does the right thing, like, hey, we're over here, and our hope is that we get the benefit of that brand recognition, and we ultimately see some of that demand come to us because we did do the right thing. Even though it was the hard thing, we did the right thing.
And I know that you guys,
one of our members shared.
That's my little girl, by the way. Harley, come. Harley, can you come say hi? No, she bailed on me.
One of our members shared that Ryan rocks.
Oh, thank you.
Thank you for doing the right thing.
I appreciate it.
Convene also created an employee relief fund. Can you tell us about the goal of that fund and how it's progressed?
Yeah. Look, we had, before this crisis started, we had just under 900 employees. Most of those employees, work on site, they deliver service to our customers. A lot of them are hourly, right? And they're in service jobs, they're cooking, they're doing dishwashing, they're doing cleaning. And they're the ones that have been most impacted by this crisis, right? The minute we shut all of our locations down, we had to furlough a lot of these folks. And a lot of them live week to week, right? They're paying for school, and this is a side gig to help them pay for school, or it's a tough situation. And so when we had to make the really hard decision to furlough and lay off people, we said, look, we're going to do as much as we can with severance. We're going to cover everyone's health care. We're going to do whatever we can as a company to take away. This is hard enough. We're going to try and soften the economic impact. And what we realized was we were limited in what we could ultimately do. And so the idea was to create this relief fund, which I've donated 100% of my salary to. A bunch of our leadership team has taken pay cuts to help fund. We've had board members and customers invest in it. And what we're doing is two things. One, providing a monthly stipend to all of our furloughed employees as supplemental income on top of what they're getting from unemployment. And then in addition to that, we dedicated a certain percentage of that money where people can apply if they're dealing with a specific financial hardship. And then we've allocated separate money that's on an application basis that we could give to people. So we just went through our first process. We had 81 applicants for the special relief outside of what we were doing monthly. And, I'll tell you, my wife and I were sitting at the dinner table reading the applications, and we were both like bawling, crying. And the human impact of this thing is, it's really hard. And it's not just the virus and people dying. And, I was on a call with our VP level and up last week, and 20% of the people on the phone lost a family member in the last 6 weeks. I mean, think about that. On top of that is losing your job and the economic stress and impact of that. So, we're doing everything we can as a company, to help those folks out. And, look, at the end of the day, it's never going to be enough. And the best thing we can do is get our locations back open, and you'll get as many of our team members back to work in a healthy and safe way as fast as humanly possible.
Incredible leadership. That's great.
Really great.
You
want to do one more? I
got one more in me.
Sure, we can do one more
before anarchy takes over and my 20-month-old is running the show here.
I'm very impressed with the way you can speak so fluently with the noise in the background.
Oh.
It's impressive talent.
Yeah, don't tell my wife I can multitask like that.
So, I guess, tell us a little bit more about this playbook that you have that you're looking to grow out. I mean, are you happy with the progress that's been made, the ideas that are being shared? And, with this playbook, how difficult do you think it's going to be to retrain, your workforce and the workforce overall to meet the new needs and the new normal?
Yeah. Look, it's an amazing question and the right question to ask. And I'll answer it in two parts. One is, what are the new standards, right? And how did we get there, and who did we work with to help us create those, which I'll talk about. And then the second part, which is actually the more complicated part, is how do you retrain our employee base to have to fundamentally run our locations differently. And you can't solve one without the other. And we're doing both. So while we've been working on creating the playbook, we're also creating an entire set of training modules, knowing that some of this we're going to have to do virtually. We're building out a whole training platform that all of our team coming back will have to be trained on and certified on before they're even able to go back and work at a location. From a operational plan perspective, our team has done such an amazing job, and we've been working on this and doing research the last 6 weeks. We're working with our partners at Eden Health and their medical consultants and virologists and stuff to better understand the virus and what are the things that we need to do from a health and wellness perspective, and making sure we're incorporating that into our plan. We've worked with M. Moser, architecture, design, engineering firm, on really thinking through spatially what has to happen and what are some of the modifications that we can make in the short term to our HVAC equipment and infrastructure. We had Ron Crain, who is the Ebola czar, who's an advisor to one of our investors, also worked with us and reviewed our plan. So we feel really good about what we've put together. I think we're taking a leadership position and holding ourselves and our customers accountable to a certain benchline or a benchmark. Will that potentially change? Yeah. I mean, this situation is so fluid, and what we know from all the experts is that we don't know a lot, right? We don't know if you get the virus and are you immune? How long are you immune for? Is it 3 months? Is it 6 months? Is it 12 months, right? A lot of coronavirus is like the common cold. I mean, I don't know about you guys, but I've had years where I've had like 3 or 4 colds in 1 year. And so we're still 6 to 12 months away from a research perspective, even really understanding this virus. And we're going to have to respond to that, just like we have over the last 6, 7 weeks here. But I think what we've created is a foundational playbook that we can continue to iterate on and evolve as information becomes more available and as we know more about the virus and the situation. We're also going to have to be flexible because every city we operate is going to probably have different rules and regulations. Like, that's the reality of this. It's going to be decided at the city and state level, not the federal level. So I feel really good about the playbook. And I feel really good about the training program that we've put in place. We've had to train, the last 10 years, we've trained well over, probably at this point, 1,500 plus people on delivering a premium hospitality experience, which is not easy. And that same capability and infrastructure and learnings and mistakes we've made and can now improve upon, I think positions us really well to make sure that when our locations do open, that our team is fully trained on the new protocols and can continue to deliver a great experience with a smile, even though you won't be able to see it because they'll be hiding behind a mask. But I think we can still deliver hospitality in this COVID world, and that's the challenge in front of us. And I feel extremely confident in our team and our leadership team that we'll be able to figure out how to do that and do it well.
I do want to ask one more awesome question that came on. If you'll brief us.
I'm in.
Okay. It's a little bit more uplifting. We're all looking for opportunities to elevate our careers through the uncertainty that's been created by this pandemic. You have built a successful business based on your foresight into future trends. From your perspective, what are the biggest opportunities for brokers and owners to add to their landlords, tenants, clients, or organizations?
I'd say the first thing is more of a mindset. Is you want to be in a solutions-oriented mindset, right? And I think we all in this industry, and I grew up in this industry, is we get so focused on the economics and the deal and the money and who's making what and did we get the better end of the deal or did we not, and what was our commission check going to be? And my sense is that in moments like this, that's actually not where value is really being created. And I think it's really about listening. It's about collaborating. It's about creating solutions and really creating option value depending on what scenarios play out. And I think there's nobody better positioned than brokers and advisors and building owners to really help today's occupiers scenario plan and really create the right solutions, not just to get through the next 12 months or 18 months, but what does the next 3, 5, 7, 10 years look like? And I've always found that you're better off co-creating that together, because I think that just makes the pie bigger and everyone wins. And if you start to get into not doing that, then, I think disruption can happen to an industry quickly if you lose sight of really the need of the customer. which right now for all of us is occupiers, right? I mean, all of us, most of us, we care deeply about how much of your workforce is remote, what happens to third spaces, what does office demand look like? We're in the camp of the more office demand for Convene, the better. And I think right now, being really solutions focused is important. I'd say the second thing is accelerate your digital transformation. Digital and what that means to all of our businesses needs to be embraced and invested in a rate that it hasn't in the past. And there's so much opportunity to reduce friction and take away some of the antiquated stuff that exists in our industry. And that's how we sell in market space. That's how we design and develop buildings. That's how we run space. And I would say that there's a tremendous amount of opportunity in the digital transformation that is happening and will accelerate in this industry. And there's some really amazing companies out there that are focused on that. And, I would not be afraid to lean into that part of the business over the next couple of years for sure.
That's great.
And be bold and take risks, most importantly.
Very good advice.
Awesome.
All right. Well, thanks so much.
All right, guys. Thank you. I appreciate it.
Awesome learning opportunity for our members.
Awesome.
Thanks, Alex, for the good Q&A.
Alex, thank you, Sarah. Laura, thank you.
Thanks. And tune in next week. We're doing our normal May luncheon with Paul Massey doing our invocation and Bob Nackold speaking. So see you all next week.
Awesome. Bye, guys. Thank you so much. Stay safe and healthy.
Thanks, Ryan.
Thanks, everyone. Thanks, Ryan.